Pricing decisions are critical to organizational profitability and long-term sustainability. Management accountants use cost information to establish prices that recover costs, generate profits, and support strategic objectives. Within the program framework, two important approaches to pricing decisions are marginal cost recovery and full cost recovery. Marginal cost recovery focuses on covering the additional costs incurred by producing and selling an extra unit, while full cost recovery ensures that all costs associated with a product or service are recovered through pricing. Understanding the differences between these approaches enables managers to select pricing strategies that align with operational requirements, market conditions, and organizational goals. Marginal cost recovery is based on the principles of marginal costing, where only variable costs are considered relevant to short-term pricing decisions. Variable costs typically include direct materials, direct labor, and variable overheads that change with activity levels. Under this approach, a product or service may be priced above its marginal cost even if the price does not fully cover fixed costs. The contribution generated helps absorb fixed costs and improve profitability. Marginal cost pricing is particularly useful when spare capacity exists, additional sales can be generated, or management is evaluating special orders and short-term opportunities. One of the primary advantages of marginal cost recovery is its flexibility. Because fixed costs are already incurred in the short term, managers can focus on the incremental revenues and costs associated with a particular decision. This approach supports decisions such as entering new markets, accepting export orders, responding to competitive pressures, or utilizing unused production capacity. A price that exceeds marginal cost contributes positively toward fixed cost recovery and profit generation. Consequently, marginal cost pricing can help organizations maximize contribution and improve resource utilization, particularly when demand conditions are uncertain or highly competitive. Full cost recovery adopts a broader perspective by ensuring that prices cover all costs associated with producing and delivering products or services. Full costs include direct materials, direct labor, variable overheads, and an allocated share of fixed production and operating overheads. This approach is closely associated with absorption costing, where products absorb both variable and fixed costs. Pricing based on full cost recovery ensures that organizations recover the total resources consumed and achieve sustainable profitability over the long term. It is particularly important for organizations with significant fixed costs and long-term financial obligations. Full cost recovery offers several advantages for strategic planning and financial sustainability. By incorporating all costs into pricing decisions, management can ensure that products and services contribute appropriately to overall organizational profitability. This approach is commonly used in industries where long-term cost recovery is essential, including manufacturing, professional services, government contracts, and public sector activities. Full cost pricing also supports investment planning by ensuring that sufficient revenues are generated to replace assets, maintain infrastructure, and finance future growth. However, it may result in prices that are less competitive in highly price-sensitive markets. In conclusion, marginal cost recovery and full cost recovery represent two distinct but complementary approaches to pricing decisions. Marginal cost recovery focuses on variable costs and contribution, making it particularly useful for short-term decision-making, special orders, and capacity utilization. Full cost recovery incorporates both variable and fixed costs, supporting long-term profitability, sustainability, and strategic planning. The most appropriate approach depends on organizational objectives, market conditions, competitive pressures, and the time horizon of the decision. Management accountants must understand the strengths and limitations of both methods to provide relevant pricing information and support effective managerial decision-making.